Hello, today we are going to solve October 2024 paper question number 2. Bilic extracted a trial balance on 30th September 2024. He then prepared a draft statement of profit or loss and other comprehensive income for the year ended 30th September 2024. Prepare the journal entries to correct the errors 1 to 6. The narratives and dates are not required. So these are the inspection and he found the errors. The first one is the credit purchases of 1150 from Roth had not been recorded in the books of account. So the two accounts that's going to get affected. One is the Roth account and the other one is the purchases account. These are the double entry, so we will correct because it is not even recorded in the book, so double entry it would have not happened. So one is the purchases account and the other one is the Roth account. Okay, so in the Roth account this value is going to appear on the credit side. Okay, so with business had purchased, so it is a trade payables account, so this is going to appear on this side, and in the purchases account this is going to appear on the debit side. Then the inventory count of 30th September was understated by 900. So we can see that, so the two accounts that's going to get affected are the inventory account. Okay, this is a closing inventory count, and so income statement will get affected. Okay, so let's put that. So closing inventory, so closing inventory, okay, closing inventory, and then we have the income statement. Okay, so these are the two accounts that's going to get affected. Closing inventory, it was understated, okay, by 900, so you had to include more, okay, in the closing inventory, and in the income statement it will appear on the other side. So let's write that. So this is 900 closing inventory debit, and in the income statement it's going to appear as a credit. Okay, had to include more of the closing inventory. So then the leasehold on the buildings of 20-year lease, no depreciation had been charged, so we have to include this depreciation. So the leasehold building at cost were at 80,000, so which means that what is the depreciation cost? It will be 80,000 divided by 20 years, so that will be equal to 4,000, right? So 80,000 divided by 20, that is equal to 4,000. So that would be the depreciation cost. So let's include the two accounts that's going to get affected are the depreciation account, depreciation, okay, and then that is provision for depreciation account, okay, provision of depreciation account. Okay, so in that we have to include this provision, so it's going to be equal to 4,000. Okay, it's going to get increased, and this we will be transferring it to the income statement as expenses, so debit. Okay, then we have the purchases of a new computer costing 2,000 had been posted to the computer maintenance account. So here, what are the two things that's going to, so a vehicle, what is that, computer account, asset account, okay, new computer, so and maintenance expense, it has been entered in as an expense thing, so we have to remove from the computer maintenance. Okay, we have to remove from the computer's maintenance account, and we have to enter into the asset account, okay, of the computers. So for the removal, the expenses would have appeared on this side. Okay, so for removal you will go and put it on the credit side, so 2,000. Okay, right? So then this has to be updated in the, you can update in the computer, you can update it in the computer's account. Okay, it's an asset account. So here you will have it on the asset side. Okay, then J Johnson, and then there is no depreciation had been charged on the computer, so this should also be included. So let's include in the provision for depreciation account. Okay, in the depreciation provision and income statement. So provision for depreciation for the computers we have to include 2000 was this, and so no depreciation, so 25 percentage of 2000, let's calculate. So 25 percentage of 2000, that is equal to, that is equal to 500. So we have to charge this. Okay, so for charging the depreciation, provision for depreciation, we will include it on the correct side as 500, and this we have to transfer it to the income statement as an expense of 500. Okay, so then we see that J Johnson, a credit customer, had paid 800 off the balance of his account in cash. No entries had been made in the books. So this was some cash that was paid by the a credit customer. He had paid off 800 in cash. So which means that you will have to, it affects the bank or the cash account. Okay, cash account. So which means that this person J Johnson's account we have to also update. He's a credit customer. It means it's a trade receivables. Okay, so these are the two accounts that's going to get affected. So a cash 800 has been received, so you will, it will come into the bank or the cash on this side, debit. Okay, and then you will have to also update in the J Johnson customers. Okay, then we have the allowance for irrecoverable debt balance should be have been reduced by 2000 on 30th September 2024. No entries had been made. So the allowance for irrecoverable debt was 2600 earlier. Now it is 2000. So we have to update this expense. So the allowance for irrecoverable debt account and the income statement, right? So income statement, so we have to update that as an expense. So this there is a decrease, so this becomes an, actually it acts as an income. Okay, so it is not an expense because there is a decrease in this decrease in expense, so which will be indicated on the credit side, and in the allowance for a recoverable debt it will appear on the debit side.